So today we are going over IULs. The reason we decided, bless you, the reason we decided to do this training is because a lot of people are writing IULs and they're not explaining it to the client, so the client isn't aware of how they should perform, what's the actual benefit of them, and they're not illustrating them correctly. So if you put a client in a predicament where they're not educated on the product they have, you put the client at a higher risk of them not actually, of hurting them more than you're helping them. So we're going to talk about what type of clients would benefit from having IULs, how you illustrate an IUL, how an IUL should perform, and then any questions y'all have from that we'll take on the back end. Well, yeah, y'all can ask in the midst of it as well. So today we're gonna have Miss Amanda lead the training. What?
That's all you want to say?
What you want me to say? Okay.
No, go.
What?
That's all right.
So an IUL is an indexed universal life policy. That's what you want me to do?
Whatever's close.
An IUL is an indexed universal life policy. It offers a death benefit coupled with a cash account that can be used to pay policy premiums or take withdrawals and loans. It builds cash value faster if it is set up correctly from the beginning.
Faster than a regular whole life policy?
Yes.
Way faster.
Way faster.
Mm-hmm.
From year one, you can start getting money, depending on which company you're using.
We have several companies that we can offer We have several companies that we can offer the IUL with. We've actually been doing some research to see which one performs better and will benefit the client more. So I think what we're leaning towards right now is National Life Group offers the client the best product in the beginning and in the long run. So Ms. Amanda is gonna break that down. That's what this is. This is an illustration, but she'll go into that deeper during her presentation. So let's welcome Ms. Amanda.
Good morning.
Morning.
Okay. So I wanted to ask a couple of questions first. Have you guys sold the universal life?
I have too.
Okay.
I did two with Mutual Omaha.
Mutual of Omaha? Okay, so, how do you vet your client? What questions do you ask?
To be honest with you, they came to me because somebody else had got one.
Mm-hmm.
And they said, well, because I was going over some, like the Living Promise and Term Express and all that, and then it's like, well, do you sell IULs?
Okay.
And I'm like, yeah. So they said, well, that's what we want, right? So I'm like, okay, fine. So I looked through it and everything, and I say, well, because I think it was a husband and wife, and they were about 43 years old.
Okay.
And they've been in their house now for about 6 years.
Okay.
So that's what they wanted. So I was filling out the application and putting the information in. I didn't know what the performance of the product was or anything.
You just did the application?
I just did the application.
Okay.
You know what I'm saying?
Guilty.
I didn't
Me
do
too.
no illustration
So you didn't
whatsoever.
explain anything, you just did
Because
the
they say
application?
their friends had one
Okay,
and they wanted to get one. So
okay.
See, I did that, and I was under the impression that illustration came with the policy once the policy comes out
Right, that's
because
what I
of the Easy Solve feature. So I'm thinking it's going to be explained on the back end in detail. I gave the basics. I didn't break down the actual illustration.
Okay.
right.
So that's why you're here today.
Okay. No problem. Okay, so what I do, so let me explain to you what I do.
Mm-hmm.
And what I do with my clients, I speak to them just as I'm speaking right now. I don't talk in insurance mumbo jumbo. I speak to them in layman's terms so they understand. I break it down to whereas a life insurance policy, you pay the policy. If you don't pay the policy cancels. A universal life, as Chrissy explained in insurance terms of what a FFIUL is. So it's part insurance and it's part tied in with the stock market.
Right.
So that's the flexibility of it, and that's where your cash value and gains a higher interest rate. So when you pay the IUL, the money goes directly into cash value. On the anniversary date of the policy, the cost of insurance pays for the policy, not the whole premium. The premium could be $100, but the cost of insurance can only be $35. That's how it builds cash value in the first year.
So the $65
So the $65
goes
sit
to
there,
cashback.
and some companies offer as much as 7.10% interest.
Right.
That's better than it going into the
In the
bank.
bank, exactly.
So what you see here, the accumulated value, so in this case, this person is paying, the modal premium is what the premium is a year. They're paying $425 a month for a $500,000 policy, okay? They're paying $5,100 a year. First year accumulated value, they have accumulated $3,336. That a traditional life insurance policy, you're not building any money for the first 4 years, easy. And the 5th year is probably only $100, if that. Even if they were paying $400 a year, they may have something in the first 2 years, because the interest rate on a traditional life insurance policy is like 1.003 point, you know what I'm saying? Because you don't have a high interest rate on a traditional life insurance product. So the question I ask my clients when I want to see, you had a married couple with a home and they were situated.
Right.
That's a good universal life person. But you need to vet your clients to make sure that this is a good product for them. Yes.
Question. I know you have a lot of experience with it. I'm trying to learn. So,
Okay.
have you seen this used as a return of premium or mortgage protection? Because I heard people talking about it, but I don't know the
Neither.
specifics. Neither, you wouldn't.
No.
Because from what I understood and what I was told, that you could use it for the 30 years and kind of like take the premiums out because you've made, I guess, some type
Not
of.
so much take the premiums out. I'm gonna get to that part.
Okay.
Because it has the feature. You're making me jump ahead.
Okay, I'm sorry.
It has the feature.
Ooh,
So say in 10 years, we're gonna go with an arrow at. They done made $43,000. It's a $500,000 policy. If they want to pull, then I wouldn't take the whole $43,000 because it has the option to loan or borrow. You never do a loan on a universal life product. You never give that option to the client. The client is going to do what you tell them to do because you're educating your client. You have to build that trust with the client by sitting there selling the policy. You educate them at that point. You only give them the option of withdrawal. That's the flexibility of a universal life product. So if they have $40,000, which is all I'm going to tell them, maybe even 35, because you never take everything, because you'll damage the product. So if they take $35,000, what they'll do is withdraw it from the face value of $500,000, and they'll leave $465,000. They'll withdraw it from the face. They don't owe nothing.
Right.
That's their money.
And that's it.
No taxes, no nothing. That's their money. So that's what they would do. That's why it's not a return of premium and not whatever else you see.
right.
You know what I'm saying?
That's what I'm here.
That's
I'm
their
learning.
money. That's
Okay.
their money.
Okay.
Tori, go get my water.
Okay.
Okay,
Go
so
ahead.
you're saying that if the client wants to borrow $35,000?
No borrow.
Not borrow.
Never
They want,
with a
they
UL.
can take the,
A loan will tax interest and it'll mess up the mechanism of the policy
so
because
there's no loan in the
I
IUL.
never do that. It is. But if you do it, you'll mess up the mechanism because the money goes into the cash value. On the anniversary date, it pays the cost of insurance. You'll mess up the mechanism with a loan.
So if
Because
you-
now you have interest taking other money out of the cash
So it would
value.
be best to tell the client
To withdraw
withdraw
That's the
from the
feature.
cash value, I mean, not the cash, from the face amount.
from the face amount.
Okay.
Withdraw the accumulated value from the face amount.
Okay.
And every year, y'all making me jump around, but it's fine because I love interaction.
Right.
I want you to ask questions too now. Every year, the client gets an annual report. This illustration is what you show the client when you're presenting. You can show it, because when you quote the policy, you have to do the illustration. You get the illustration as you're quoting. Most companies let you do this, and you show them the money. That's the beauty of a universal life. This is what I like to do with my clients. Because, oh, you want a UL? Let me show you what the UL does. And I show them, this what you paying, and this your money right here. And this is what normally sells the policy, right there.
That accumulated value.
And then sometimes, so if this $100,000 policy, sometimes this right here gets so big, it starts taking the face value higher. Now, in this case, this is an increase in face. There are two types. You got a level benefit, which if it's $100,000, it's gonna stay $100,000. The only way that $100,000 grows is if the cash value gets so high, it makes the face value grow. This one here is an increase in face value, which this face value increases every year from the start. So those are two different type of universal life policy products.
Yeah, level growth and
Level death benefit,
level death benefit.
increase in face benefit. Every year the client will get a annual report. What the annual report does is show them how the policy is performing. An annual report lets you in their house every year. Anytime a client lets you in your house, that's an opportunity. That's how I look at it. That's an opportunity to make another sale. That's an opportunity to give them service. That's an opportunity for you. That could be a referral. That's new business. That's an opportunity. But every year they get an annual report. Go see that client. That way you keep another agent out the house. Yes, Chrissy.
When you go in for your annual reviews, do these clients ever want to increase
Yes.
their IULs? Or?
Yes, sometimes they do, because things change, situations change.
So an increase, would that be an increase to the premiums, or is that something they automatically do on their own? Because I know when you can overfund, or you can fund at a regular rate and you can underfund depending on your financial situation.
but
is that how you do the increase?
Okay, so depending on what company it is, sometimes, and this is what you have to be careful with. Sometimes you may have to do a projection. I didn't get to this part.
What?
Reprojection.
Reprojection. Oh, okay.
Because insurance, just like all insurance, is based on age. The cost of insurance increases as the insured increases. So when you do your illustration, this is only one, right? This is one picture, right?
Yeah, we have the 20-year projection also.
Okay.
Oh, it's at the bottom.
Okay. You have to make sure that when you do your illustration, it goes all the way to age 120. Because the cost of insurance increase every year as the client gets older. Sometimes some companies don't do the projection all the way until the client dies, basically. Right. And so with the cost of insurance going up, sometimes the client can be paying for the insurance and the insurance can cancel. Because even though they're building all this cash value, if the cost of insurance go up, and they say they're paying $100, the cost of insurance surpasses the $100 and it can get to $110. Guess where that $10 coming from? Cash value. If you get to $150, that $50 coming from the cash value. So they can't really deplete the cash value if you don't project the illustration correctly. So going, checking on that annual report, seeing the client, making sure everything is good. You have to go see your client and make sure they're okay. Go ahead.
So, is there a cutoff point where a client can join the IUL? Or
No, whatever the company, 81, 84, 75, whatever the cutoff age is for a client.
Okay.
Whatever the cutoff age is, and if they want to pay it. But there is a minimum that you can sell. Some companies is 50,000, some companies is 100,000.
Depends on the age.
It depends on, no, not the age. It depends on the volume of insurance.
Oh, okay.
Mm-hmm. When you're doing the illustration, it's very important that you input all the information accurately, because that has bearing on your illustration. That has a lot of bearing on your illustration. That way, there are no errors. You have to be careful when you input whatever it is, the client's information, date of birth, whether it's increasing level, like non-smoker, smoker, because once the company does their information, it can come back, it might be $100 more, $50 more. You don't want to have those errors and then have to go back to the client, because it's it's going to affect your cash value, and it's going to affect what they pay. Yes.
Okay, so at the top I see where it says lapse year. When it refers, it says 85 lapse year. So what is
in 85 years?
85 years is, that's it. Okay. So it's not by the age. So I'm thinking.
So this probably is going to take, policy year is in 85 years.
Okay.
See that?
So I'm getting, okay, I'm thinking age and policy year. Okay. I got you.
Because this is the age. It's starting at age 35. So it's going to go 85 more years.
Okay.
So policy year, that's lapse year.
Gotcha.
Yeah.
So you said the motor premium was $425, 42, and the target they got there is $5,105. That's how much they pay for the entire year?
Yeah.
That's the 425 times 12.
So what is the minimum? What's that? The
Minimum.
one next to it to the left of the target.
Minimum premium, that's what they need to pay. This is the cost of insurance, which is half.
To keep
And
it
that's
in,
gonna come out of the 5,000?
And the rest of it sits in.
but that minimum was to keep it in force.
That's the minimum
But-
they need to pay to keep it in force,
Does
which
that
is
go
basic.
up with the age?
Yes.
I don't know
So
if I'm
that's where you gotta see it every year to be able to see what that means.
So say they can't afford to pay the $5,000 a
They
year.
gotta at least pay.
They gotta at least pay this to keep this from lapsing. And that's just for that year.
Now, what if I want to pay? Say I want to pay $6,000 a year.
You need to call the company.
Okay. So I can't just overpay when I want to. Okay.
No, because back in the day, Universal Life were known as cash cows. And they will also use the London money.
Oh.
And that's where
Overfunded.
MEC, see that right there?
Yeah.
That's the max that they could put in the policy. So
Oh,
the
okay.
laws changed, and that's why it's a max that they could put
The
in
max
there.
per year. But I have to call the company to
Yes,
get an approval
sir.
first.
Yes, sir.
Do you have to give reasons why, or you just say?
No, you say, hey, I just want to pay this off. I just want to pay it off.
Okay.
So what she said for y'all that's on here is you have the module premium, which is the amount you pay monthly. The minimum, the target premium is the amount you pay annually, which
If
is
you just-
$5,000.
And if you just want to pay it one time, right there.
They have the guidelines single premium that you can pay one price up front. They have the minimum premium, which on this policy specifically would be $2,665. That's the cost of the insurance. So from the minimum premium to the target premium, you can see what your increase or what the growth would be annually on this policy. So that's roughly about $3,000. Just so y'all, because I know y'all can't see the screen.
Oh.
And the MEC premium is $16,434. That is the max amount you can pay per year without, on that policy. That
Without them people coming to get you.
right. That's to prevent fraud.
Go ahead.
Okay, that guideline single premium, that's a total amount of how many years? About 10 years or so?
That's it.
Yeah?
Yeah, you could drop that in there.
So you put that in there and then it just
That's
automatically.
it.
Everything, when you put that in there,
That's a guideline single
everything you
premium.
see right there on 10 years, you already have that once you put
10 years, that's everything. Guideline single
That'll
premium.
be for the 85.
That's it.
Yeah.
That's all. If you got $68,000 and you just want to pay your insurance
It's like
up
an
one
annuity
time, boom, you paid your insurance up.
And your death benefit would be what?
$500,000.
$538,000.
Well, no, it'll be a little bit more than that because this was an increase in phase. I wonder because every year this policy increases, but that's a guideline single premium. So that would be a question that we would have to ask the company because the face value of this policy is actually more than that. This is just in year 21. The face value goes higher than this.
Right.
So I'm not sure. We would have to call the company and ask if a person would want to pay $68,000 just a single premium, what would be the face value if if they just paid the single premium. So that's something that you would have to call the company and see what they would end up with.
So would it be like say if somebody put that amount of money in that plan, and I'm sure that they can't just go and say, okay, let me take $50,000 out of it.
Oh, yeah, no.
Because then they'll be saying, oh, this
Yeah,
person's laundering money.
they're gonna have to talk to
But if
somebody.
if somebody is saying they can put 68,000 single premium into this, I'm a pause and make sure we're doing due diligence for the client. Because they might need an annuity instead.
Exactly.
So.
Correct. But if you drop that in there and then, you remember when you took that test.
I know.
You can't be playing with that money like
You
that.
got some people, they doing the same thing
That's
we doing
a
right
wash.
here.
That's a
Studying
straight
this
wash.
to see where they can wash their money.
Nah, that's a wash. And as an agent, I would be concerned. I'll call the people first because my name on that application. So no, don't call me asking me about no withdrawals. No. I'll be calling I'll call the people on you. So no. So even the contestability period definitely does apply, even though you can withdraw the first year or whatever, but contestability period definitely applies here. So what else I want to tell you?
What is the surrender value?
Surrender, the first 2 years, I think it's 10 years that there's a surrender value. They calculated the first 10 years.
So the accumulated and the surrender.
Accumulated.
Surrender is what you can get, and accumulated is what's there.
Like if you want to cash it in.
Yeah.
If you wanted to cash it in, I think the first 10 years, after 10 years, I believe there's no surrender value. But that's another question you need to call the company and make sure of. But it says 0 there, but I think there is a surrender value up until the 10th year. I think it does kick in after
10.
Yeah, because after 10 it's the
after
same.
10.
It does.
Yeah.
That's
After
why he was
10.
showing the 20 years.
Yeah, after 10, I think it's no surrender value. Okay, I told you about that. Accumulate value on withdrawals. I told you
We're gonna
on
go
those.
over how do you qualify.
Okay, yeah, I qualify my clients because I always ask, my first question is, what are your goals? So, once a person defines their goals to me, say they're buying a house or they already own a house, if it's a married couple, or if it's a person that wants to save money, but they don't have a lump sum for an annuity or something like that, but they are looking to save money or they are looking to buy a house, but they do have a stable job. I qualify them for a universal life, but it has to be somebody really stable, because if not, it has to come out the bank. And if it's somebody that is not diligent with their bank account, if it's not somebody diligent with their bills, this is a waste of your time and messing up your persistency. So I vet. I definitely vet. I ask a lot of questions. But I do it in a nice manner, but I'm vetting. And if it's a married couple, they got kids, but it's still, that's still, like a gray area with that, but I still vet. And then even if I sell them traditional whole life, but they're still my clients and I'm doing reviews, because I definitely do reviews. I go back and see my clients. I keep a log of my clients because I don't have a database. So I go back and I see them, and if I see that they're a good client after a year or two, I'll roll them over into a UL. Because I still ask, what are your goals? What are you doing? What are y'all looking to do? And those are fair questions when doing your due diligence prior to making that sale. So, just have a conversation. They'll tell you. And it's not like you being nosy, or because it is always good to build a relationship with your client. It's not just walking in and boom, 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 I made a sale, I'm out of there. Build a relationship, because one thing they taught us in the business, is the yes question. I don't know if y'all know about this. While, when I'm finishing up with my application, you know, I'm like, did I do a good job? Yes. Did all the questions, was I thorough with everything, explaining everything to you? Yes. You think somebody else could benefit with what I just sold you today? Yes. Did you write their names down so I could go see them too? Yes. You know what I'm saying? So there are a lot of things that I've learned along the way that still benefiting me today, because don't ever be afraid to ask for referrals. But just make sure you still are doing your due diligence with the client and not just, oh, I wrote them, I see them later. Because you just have to build relationships and trust. So, let me see. With Universal Life, just start reading the benefits. Make yourself familiar with the benefits. That way, when you're sitting down talking with a client, you're familiar and you're not, you know, stumbling with the benefits, and that way they can entrust you with your sale. Just make yourself familiar with the benefits. Y'all can have my phone number anytime. You can be with a client, call me.
I can call you.
You call me, girl. Yeah, just call me. If there's something that you need me to answer, if you need me to go to sales call with you, I'll go. Just call me. Let's see what else I wanted to tell you guys. Oh, and also chronic, I think chronic already comes with, terminal I think comes with it, but chronic and critical comes, you just click those buttons and that's free of charge. So those three automatically comes with it. Accidental death, child writer, long-term care I believe comes with it too, but that's, you have to be licensed to sell that. Y'all have any other questions? You got a question?
Oh, yeah, I just got here, so
What's up?
I had to kind of let it soak in. Okay, so the guideline level premium is what I have a question about. What is that particular premium, guideline level? The $14,639.
After the MEC.
I'm sorry?
$14,639.
MEC premium.
Next to the MEC premium, guideline level premium.
Is that the annual MEC premium? Is that the 5105 times?
The 14,000.
I know. Is that the 5105 times 12? No, that's not.
That's too small.
Yeah, that's too small.
Or that might be the 26.
The 26?
Times
2665 times 12?
Oh.
Yes, no? I don't remember right now.
Okay.
Oh no, I forgot. Hold on, so
That's not her.
the minimum is to keep it in benefit. Target is what you pay every year. The MEC is the max you can put in. So that must be, if it's the MEC is the max that you can put in, the guideline level must be what you can pay, because if the MEC is the max that you can put in, the guideline level must be what you can pay, right up under the max that you can put in per year. Because the MEC is the max that you can pay per year.
Right.
So the guideline level gotta be right up under that. But I'm gonna make a phone call and I'll tell you in a minute.
Well, if you have,
It says it's the level annual amount payable over a period not ending before the assured attains age 95.
Say it again?
It's level annual amount
Yeah, I figured it was annual
payable
amount.
over a period not ending before the insured attains age 95.
So, yeah, it's right up under the MEC premium. You hear me? It's the annual amount that the client can pay, but the max is the 16,000.
$16,434
That's the max that you can put in per year,
per year.
per the MEC.
What does NBC mean?
MEC is the people. That's the people.
Before they start,
Oh, no.
You go to jail.
we need to see you.
That's the max you can put in
Okay.
per them people.
So you won't
So
start
you can
carrying
pay.
into what you're doing.
Yeah.
I got you.
So the minimum premium is what goes toward the life insurance
The
portion
minimum premium is what you can pay to keep the policy in benefit, keep it from lapse.
to keep it from lapsing. The
Correct. The
target,
target premium is what you're paying every year, the 5105, that's the 425.42.
okay.
And then, so the MEC premium, that's the
Okay.
max that you can dump into the policy
You don't
per
have that
year.
in the illustration.
Okay, so that's the plan premium. So, okay, so since I'm 35, you can use me for an example.
Mhm.
So the plan premium, 5105 is what I pay a year, which equals out to the 425.42 per month. That's how much I would pay toward my IUL
Mhm.
monthly.
Mhm.
Now, a portion of that, the accumulated value, what does that mean? That's the value
That's your cash value that you will earn every year.
every year.
Correct.
But I'm never able to borrow from that until the third year, not that I
No,
should
ma'am.
borrow.
No ma'am,
Right.
no ma'am, not borrow, we don't do borrow. We
Right.
don't borrow nothing from,
Well,
UL.
so what would be the appropriate term?
Withdraw, you can
Okay.
withdraw from the face amount. So you have two options, but you never, okay, I'm sorry, y'all, let me do this right.
Mm-hmm.
Okay, so you have two options, you can borrow or you can withdraw from the face amount. When you make your payment for universal life, it goes directly into the cash value. It's the cash value pool, okay? On the anniversary date of the policy, it pays itself only the cost of insurance on the anniversary date of the policy. The remainder,
Meaning the anniversary date, meaning the year
No.
that you kept it?
monthly.
Oh, monthly,
Monthly,
okay,
that could be the 25th, that could be the 15th, whatever date is the anniversary date of the policy.
okay,
So you could have took the policy out on the 15th, but the actual date, the submit date could be the anniversary date. So there's two different days submitting there. Because once the company, because sometimes it gets confusing, when you choose a date, you might be paying behind on the policy. You could choose a date and you're paying before on the policy. The company designates which date is the anniversary date, okay?
okay,
So, on the anniversary date, the policy pays for itself. You could be paying $100, the cost of insurance could be $35 or $65. $35 remain in the pool, and the $65 goes to pay the insurance. So the money that's left in the cash value pool is accumulating interest immediately in the cash value pool.
okay, that's the part that's invested,
Yes.
Yeah.
that's the part that's invested,
And that's why you have cash value in the first year.
okay. Accumulated value, that's cash.
That's cash value.
Right.
Surrender value is the money that you
That's
can
what you would be
withdraw.
charged if
If
you
you
try
close
to close it out, if you surrender it.
Okay,
Question. If, just say for instance, the two people, the married couple that I put into an IUL with Mutual of Omaha, could they roll that over into
Mhm.
National Life Group?
And you would do a replacement,
A
so they
replacement
would not
policy?
lose the time that they've already started that policy. Yes, sir.
So to be
Because
fair,
now, most companies that I've seen now, when you do replacement, you don't have to drag those forms around. You just click the replacement and they include the replacement forms with the policies electronically. Always, when you're doing a replacement, do the replacement.
And tell what comes with the replacement, like you told me,
Okay,
about the
so
contestability period.
the contestability period, so if they've had a policy 8 months, they don't have to start over with the 24 months. They take
They got
that 8
16
months
months.
with them, correct, they
Right,
take that
I
8
got
months with them, and so they won't have to start the 24 months all over again.
So they already finished the 24 months. They good.
That's right.
As long as you replace it.
as long as you do a replacement.
Right.
Just click that button, don't do that to the client.
And it's still gonna be based on when they first started.
They first start, that's right, just put the name of the company and policy number, and they'll pick it up from there. Cause that company notifies the other company, hey, this person doing a replacement, and they just verify it, and it goes on to the next company.
And it's literally a matter of putting in the carrier that they have the other policy with and the policy
And the
number.
policy number.
They do all
It's
the
simple.
other work for you.
So I got a person that, considering doing a college fund for they got a 10-year-old daughter. She figured you got about 7 to 8 years before she graduates from high school.
Mm-hmm.
It'd be better for her to put her in something like this? What you think?
Well, do they have a lump of money, or do they
well-
wanna pay per month?
It's gonna probably be paying per month.
Okay, well, you could talk about 7 years, let's look at 7 years here. 7 years here is $32,000. It just depends on how much money they wanna pay a month. And you can't put it at the child's age, because the child gonna pay probably $50 a month, which is not gonna be a lot of money.
So it's
because
probably
you-
best to put it at the
at
parents.
the parents' age, but, and from back when I started, MetLife got sued for calling stuff a college fund.
Mhm.
So I wouldn't use that word.
That word, okay.
So if they trying to, what are your goals? Start back there. What are your goals? So if the parent or the grandparent wants to accumulate some cash, they could pay like $200, $300. It's just like putting it in the bank
Right.
at 7% or 5%, which is higher than a bank.
Right. Okay.
So that makes sense.
Yeah.
So, cause I know a company that does it at 7.10. I know a company that does it at 5. It just depends how the health of the individual, could they qualify for it, because it's still life insurance.
If y'all have questions on here, y'all can ask. She'd be able to hear you.
Okay, so input information, premium, target premium, I talked about that. Calculate, verify, phase the cost. Oh yeah, and when you do your illustration, make sure you check it. I know I told y'all to make sure you enter everything correctly, but just make sure you check it. Make sure you qualify client for policy. Okay, I think I've done everything I have on here. Unless y'all got some more questions. Y'all good though? You think that y'all
No
can-
questions on Telegram?
Y'all think y'all could go out and sell a policy?
You answer mine.
Huh?
I'm just gonna call you.
And FYI, we do have access to this
Say it
company,
again,
which is
Ayana.
National Life Group.
Mhm.
That's the one group.
So I heard her say you have to qualify for this product because it is a life
By the
insurance
client.
product.
What happened?
Right.
So I guess, like, what would be some disqualifiers for someone for this product?
It's insurance.
That's not a crazy question.
No, it's not. Never, no questions are crazy questions. Tell them no questions are
She can hear
crazy
you.
questions. Oh, okay. No questions are crazy questions when it comes to insurance. Don't ever think that. It is life insurance. So it's just a matter of them getting approved for the product.
Okay, I asked because I had a client that did not qualify for an IUL.
Which
So I
company?
guess that was with Mutual of Omaha.
In real street.
So with mutual, you have to remember to factor in some of the stuff like if they've had diabetes before the age of 50, or if they take more than one medication for hypertension.
No.
If they have anything listed on
Ask her
any
how
cycle
old.
meds,
How
any
old?
psych meds. How old was your client?
She's 55.
That's why, because they was knocking mine down like boulders.
Because of the age?
I don't know.
Real
They
street.
batted a lot of my clients.
Two thyroid medicines and a pain management medicine.
That-
That's it.
Oh, it's the
Payment.
pain management.
Payment.
That's right, that's it right there.
Yes.
Payment, right there.
Cause they was batting mine down left, right, and sideways. They
Pain
made me
meds,
feel
blood
real bad.
thinners, all of that will knock them out.
Now,
Did I hear you say they're on
Psych
Did you say
meds.
something about psych meds?
Psych
Okay.
meds.
Yep.
I don't see this,